Checking in on the closing price of oil. We have oil under a bit of pressure today, moving to the downside. Oil off just around 1.5% at $56.74 a barrel. Now the move to the downside coming after U.S. government data showed that large builds in refined product stockpiles. That's weighing on the price of crude today. We have Philip Striebel, senior market strategist at RJO Futures, joining us now from the CBOE. And Philip, you take a look at the move to the downside in oil, falling further below that $60 level. What do you expect is ahead for crude?
You know, I think it's going to be a bumpy ride for crude. I think we're really trapped between like 56 on the low end and $60 on the high end. We ran up about $4 last week on news of that hurricane shutting down about 50% of the platforms out in the Gulf. They're still down as of now. It's taken off about 1.1 million barrels, but it didn't reflect in the data at all today. We saw that a little bit of a drawdown. That bumped it up just a touch. And then as the day went on, it's the longer term fundamentals are weighing in. I mean, if you look at the total inventories we have right now, it's about 455 million barrels. And if you look at the 5-year average, it's right around 423 million barrels. So the U.S. right now is just flush with crude oil, and it makes sense that prices are heading lower.
Yeah, Phil, we had the number of active oil rigs in America sinking to a 17-month low last week, with the rig count declining 10 of the past 13 weeks. Is there a concern at all that U.S. production has hit a peak?
Yeah, I don't think so. And, you know, if you look at the way they used to place the rigs out, they were just one on top of each other all the way along. And now what they're doing is they're repositioning the rigs, being a little bit more strategic to them, and then also using that excess capital that they have by downing the number of rigs they have and reinvesting that into rigs that are better and more efficient. So I think that the real issue, though, is pipelines as far as infrastructure. The pipelines right now are just completely overloaded. So if they did have those additional rigs all running at full capacity, there would just be a massive glut of oil out there. So I think right now they're doing a smart thing by downsizing the number of rigs, and number of rigs going down hasn't really had any kind of impact on the price of oil. It's not like where we saw with natural gas when they were taking those rigs out of the Gulf. We saw natural gas prices rising as a result of it. So I don't think rig count necessarily at this point is a key piece of data at the moment. I still think that it's the traditional EIA data is what's moving that market the most.
Philip, you talked about the bumpy ride that you expect to see for oil prices. How do you see the geopolitical risks, specifically the latest developments coming out of Iran, playing into the future price of crude?
You know, we were really watching that, and I mean, that's definitely a key headline that you have to pay attention to every day. I mean, if we do see those geopolitical risks begin to rise again, you could see oil prices push back up into even triple digits. We've seen it years back. You know, we once saw that Iran had captured about 9 Navy, seamen that were out at sea. They grabbed them, and oil prices immediately went up $8, and that was in the after hours. That was years and years back. So you could see how susceptible oil prices are to any kind of geopolitical threat. So I think it'd be wise as a trader to hedge the upside and definitely look at those far out of the money call options. It's just cheap insurance in case something does develop.
Philip, switching gears here a little bit, I want to get your thoughts on gold. We have gold reaching a 6-year high today. Earlier, Ray Dalio actually wrote in a LinkedIn post that gold will be a top investment for global markets. Taking a look at where gold is trading today at $1,425, what do you see ahead?
Yeah, I can't agree with them more. I mean, if you look at gold, they are widely anticipating that the Federal Reserve is going to start to cut rates, and that probability for that 50 basis point cut did jump up to about 33%. So we saw weaker economic data come out of the housing market this morning, and that's kind of a key figure, and it tells you the state of the economy. They have to cut rates right now if they want to build up the housing market. So if they cut rates, dollar index comes down, and gold is that store of value investment that people are looking for. Something real interesting to point out is that silver has been on the move over the last 72 hours. So silver could be just a touch bit better of an asset class than the gold market, but gold is something that's widely held by central banks, and I think that it makes sense for people to own.
All right, Philip Striebel, thanks so much for joining me today.